Welcome to Livewire Markets. My name is Vishal Tekshanani. Thank you for tuning into this episode of The Pitch. I'm joined by Joe Millward, founding partner of Epsilon Direct Lending, and he's going to give us a crash course on how to make money in M&A financing. Joe, welcome.
Thanks for having me.
Of course. So Joe, the corporate mid-market appears to be fertile hunting ground for corporate lending. What makes this opportunity set so compelling to you?
Well, it's a large, stable segment of our economy, and our population, our country relies on the mid-market. It's one of the largest employers as a segment. It's one of the largest taxpayers as a segment. It's huge in terms of contribution to GDP. About 35,000 companies in what we call the middle market. That is companies with turnover of between $25 million and $500 million, typically with 20 to 200 employees. So it's a really deep, diverse segment of our economy. Normally these companies, you won't think about them, you won't notice them, but they're performing a critical role in your day-to-day life. And so we love it because it's so diverse, it's so deep, it's so stable. It's not kind of subject to the ebbs and flows of large capital markets and headlines. It just keeps on keeping on.
Okay, so one of the challenges for potential investors is understanding how their capital will be put to work. How does Epsilon deploy capital to generate returns in this segment?
Sure. So what we're doing is supporting the growth of the segment that I just described, the middle market. And typically that growth is an acquisition that's being taken out by a company. Sometimes it's a private equity firm that is buying that company. Sometimes it's a multi-generational family that owns a company is buying a competitor. Other times it might be an expansion into a new geography or a product. We're providing senior secured lending to support that acquisition. In the example of an acquisition, we're funding, say, 30, 40% of the value of the acquisition, the enterprise value of the company that's being acquired. And then a private equity investor or a high net worth investor is funding the other 60 to 70% with equity capital, first loss capital.
Okay, so one market, many different types of businesses like you outlined there. So due diligence is critical for any lender. How do you sort out good deals from bad? What do you look for in your due diligence process when you're funding these opportunities?
Sure. So we're only lending to profitable companies. We require our borrowers to have at least $5 million of earnings, and typically they're a market leader, number 1, 2, or 3 in the niche, the segment that they occupy in the middle market. So they're a critical services provider, they're a critical goods manufacturer, a healthcare business, an education platform. These are essential goods and services that are supporting our economy. So we screen for those kind of quality elements, and we really focus on the sustainability and predictability of that $5 million or more of earnings in order to support our loan. So how do we validate that? Well, we get a lot of due diligence, Vishal. So we'll get a sort of comprehensive investment memo that's provided by the buyer of the business with a 3-way financial model looking at the companies or the target's P&L, cash flow and balance sheet. We'll have all of their financials inspected by a top-tier financial advisory firm, a KPMG, a Deloitte, who does financial due diligence and tax due diligence. We'll get a management consultancy sometimes to do commercial due diligence on the competitive landscape and the reason this company exists. We'll get legal due diligence performed by a top law firm sometimes that looks at contracts, employee positions, and so on and so forth. So lots of paperwork that support our investment thesis, which ultimately focuses on how sustainable and predictable that earnings base is, and we structure off of that when providing the loan.
Okay, very rigorous indeed. Can you talk to us about the difference between sponsor and non-sponsor deals? What does that mean and what are the differences?
Yeah, sure. So by sponsor, we mean that a company is owned by a private equity firm. We're dealing with middle market private equity firms in Australia buying Australian companies. So that's what sponsored means, is they're sponsored by a private equity house who is acquiring them to support their growth. Non-sponsor simply means there's no private equity house involved. And that typically means that there's an independent shareholder owner, sometimes shareholder manager who is running that business. Typically when we lend to those companies, they're multi-generational family-owned businesses that have decided not to sell out to a private equity sponsor, but to continue to keep the business within the family and support its growth.
Okay. And can you give us a real-life example of a current investment opportunity that you're backing?
So we have recently funded a loan for a private equity house who specialises in healthcare assets, and that company is one of the largest clinical trials businesses in Australia. And Australia is a wonderful place for clinical trials because it resides in the Southern Hemisphere, so it gets an overweight share of the global testing market for things like seasonal vaccines, like flu vaccines, which require annual testing as new strains are released. Australia gets an overweight share of that segment, so we've got a wonderful kind of positioning as a country to support clinical trials, and this company is the market leader. It's been around for a very long time. The private equity house has bought this business to support its ongoing growth and expansion as the industry is professionalised and supports critical development of drugs to support our healthcare system.
Wonderful. Joe, thank you for coming in and educating us about M&A financing from a private lender's perspective.
Pleasure. Thanks for having me.
No worries. I hope you found this video informative. Please don't forget to like it, subscribe to our channel so we can keep producing more content like this. My name is Vishal Texanani. Good luck with your investing strategy.